Welcome to another episode of Quest for Twice. Today is July 22nd. The earnings season just got started. So today I'm going to review earning updates from two companies in my portfolio. The first one is Kinder Morgan. So as always, Kinder Morgan reports pretty boring earning updates, which is good because that means its results are very predictable. So we can look at the estimated 2023 EBITDA came in at 7.7 billion, same as the estimate in the Q1 update. And there is no change to its net debt. No change to its estimated 2023 DCF coming in at 4.8 billion. And no change to its growth capital of $2.1 billion. Again, no change to its forward dividend at 2.55 billion each year. So just a reminder, we add capex and dividend together, we get 4.65 compared to the DCF of 4.8 billion. So there is a slight free cash flow left after paying capex and the dividend that can be used to buy back shares, which is actually what Kinder Morgan did in this year. It spent so far about $330 million of money to buy back shares at $16.6 per share. That's about the same amount of money it spent last year. So I think the best valuation metric to evaluate Kinder Morgan is its forward dividend, 6.4% yield at $17.5 per share. So that's about 2.5 percentage points higher than the 10-year yield. So that is the premium we are getting buying Kinder Morgan instead of a risk-free 10-year yield. So I think that's a fair price. So I would say at $17.5 per share, Kinder Morgan is fully valued to its potential. Next one is Equifax. So the management reported that the mortgage headwind continues in this year. You just keep in mind that last year there were 56% fewer mortgage originations compared to 2021. And in this year, so in the second quarter, the mortgage revenue for Equifax was down 13% compared to 1 year ago. That's actually a slight improvement from down 33% in the first quarter this year compared to 1Q 2022. If we look at its non-mortgage constant currency revenue, its quarterly growth was 6% from 1 year ago. That's a deceleration from a peak of 22% 1 year ago. However, the management gave a guidance of that non-mortgage constant currency revenue growth of 9% in the third quarter this year. And that's within its long-term growth framework of 8 to 12%. The slower growth in the past quarter was because of some headwind from the EWS segment because of the layoffs from the IT and other industries. So there were less revenue growth in those verticals. As a result, it only delivered 6% non-mortgage revenue growth. However, its EBITDA margin in the last quarter came in at 33%. That's almost 2 percentage points higher than the first quarter. The management also guided higher margins in the third quarter and the fourth quarter of this year, with 36% exiting at the end of this year. So that's because of margin impact from mortgage market headwind, and the stock compensation was partially offset by its cost reduction effort, which includes about $130 million of OPEX reduction in this year and 80 million CAPEX reduction in this year. So the management has taken measures to defend its profit margins. Let's take a step back to look at the growth drivers. The number one growth driver is the cloud single data fabric with a high reliability and availability. So nothing is changing there. Equifax has completed the cloud migration for the workforce solution segment and will completing the USIS segment migration soon. The second driver, that's new products and innovations. Equifax delivered a 14% vitality index in the past quarter. That's above its long-term goal of 10%. So its new products and innovation initiative is going strong and bodes well for its growth. As I mentioned earlier, the workforce solution is a long-term growth driver, but in the most recent quarter, it was facing some headwind from hiring freeze. However, if we look at the charts on the top right, we can see Equifax is continuously growing its number of contributors as well as number of records. So the underlying asset is growing and bodes well for its long-term growth. Lastly, mergers and acquisitions. It got stakeholders' approval to purchase BVS in Brazil in the third quarter of this year, which will add $160 million of run rate revenue. So now, if we count all the acquisitions since the beginning of 2021, the added run rate revenue would be $610 million per year. The company will pause with the major acquisitions to reduce debt and digest the recent acquisitions. So that will help its financial strength and be ready to deal with the general economic weakness if a recession hits. So there is a very little update to my initial investment thesis. At $215 per share, its enterprise value is $32 billion. And over 2023 EBITDA of $1.7 billion, that give us 18.3 EV to EBITDA ratio. And that's with the very high margin mortgage business is currently depressed, as shown in the chart on the top right. So as we can see there, the number of mortgage credit increase were significantly below the long-term average from 2015 to 2019. So that the business will eventually rebound to historical norm and adding very high margin business that will help to expand the future EBITDA rapidly. Therefore, I think at 18.3 EV to current EBITDA ratio, that's a reasonable price to pay for a company with good long-term growth potential as well as with a wide moat. As I mentioned in the previous reviews, its moat is wide and growing with more data because as a leading data provider, it can extract more value from additional data than its peers. So I believe with the mortgage market even depressed and stay at a low level, the company will resume growth once the difficult comparison passes in this year. So I feel very comfortable to own this company stock. And if it has a significant pullback, I may even add to my position. This concludes this episode of Quest for Twice. Until next time, happy investing.